We are now joined by Mr. Deosthalee, Wholetime Director and CFO of L&amp. Mr. Deosthalee, good afternoon. This is Nikunj Dalmia from the ET Now studio. Good to have you on the show, sir. First, let's get the big sketch from you. MAT versus the reduction in tax rate. Which is more beneficial for India Inc.?
Let me first start with some kind of a disclaimer, because we haven't seen a final document which is going to be tabled in Parliament. So what we have heard is from media and from the television channel. So my comments are based on that. Number one, if you look at the reduction in the corporate tax rates, in the original draft of DTC, it was proposed that the corporate tax rate will be brought down to 25%, and now what we see is 30%. While it is a bit lower than the current maximum tax rate, it falls short of the expectation, and there is a scope for further reduction going forward. But this is better than the current tax rates. As far as MAT is concerned, I think we need to understand the historical perspective. This particular provision is there in the Income Tax Act in varied forms since 1984, and we've seen different versions of MAT, in the sense that earlier it was some years ago rather, it was 30% of book profits. Those were taxed at varied rates. If you go 5 years, 6 years ago, it was around 10%, 11% increase. Then thereafter, it was increased to 15%, 17%, and now in the current tax laws, it is almost at 20%. And this is pretty high. If you look at the overall ceiling of 30% and minimum alternate tax at 20%, I do not understand what is minimum in it. It's very high, and it is going to really create some trouble for the companies which are investing, infrastructure sector, and many other capital-intensive industries. So this percentage needs to be looked at. Also, there needs to be more clarity on MAT credit, because we don't know whether that MAT credit will be allowed or not. Here also, there have been a lot of changes. Some industries, the MAT concession was not available, that was withdrawn later on. So a lot of changes have been made in this provision. There needs to be clarity on this, and I think our view is that the percentage needs a definite look. Well, first of all, let me tell you there are some definite welcome features. As we understand, that provision of taxing on gross assets has been withdrawn, and the taxation will be in line with the current provisions. So from that perspective, it is good. However, the percentage is pretty high. So if currently it is 19.93%, and that percentage you have to look at from the point of view of the maximum tax rate of say 33-34%, and now the tax rate has been brought down to 30%, and MAT has been kept at almost 20%. So one thing is very clear, that yes, the changes are welcome in the sense that from gross assets to taxation on profits, because that was conceptually a completely different perspective, and today we have come back to the past and we are saying that we will tax on profits. That is one. The other important point is that India needs a lot of capital formation, I should say. We need a lot of investment. We are talking of $500 billion of investment to be made in infrastructure sector. We are talking of power stations, power plants, other infrastructure areas like roads, ports, airports, and all these require significant investment. And if these companies were to pay tax even before the operations commence, then I think it is going to be a severe dampener. So my point is that operations come in the real sense. You may have some marginal profits in the first 1 or 2 years in the books of accounts, and if you start paying this minimum tax from that period onwards, it's going to be a dampener as far as the investments are concerned. So I think capital intensive industries and infrastructure sector, these two sectors are going to be somewhat affected. Although, as you will say, that the current tax rate is 20%, and therefore there has not been any change. But I think the industry was looking at reform. This is not a reform according to us. If you look at the overall tax rate which we pay, it is in the range of 31 to 33%. So that's the rate which we pay. If we introduce, once the DTC becomes operational, the overall tax rate may come down to 30%. But L&T is only one part of the story. We today are investing substantially in infrastructure. That means we are developing roads, ports, airports, and I think these SPVs will become operational soon. Many of them are currently also operational. So once they start making book profits, immediately they have to pay this 20% tax. In spite of the fact that they have a huge tax depreciation, and then if you look at the tax liability, it will not be there. But you will have to pay tax, and according to us, that's the reason why we are saying that the provision may be okay that we have to tax on book profits, but let the percentage be lower than 20%. Well, what I understand is that the long-term capital gains tax, there will be some deduction allowed. You see, originally when the original code was announced, the entire capital gains were supposed to be taxed at the maximum rate. Subsequently, some amendments were announced, and we believe that the new code which has been approved and which is going to be tabled will contain the revised draft, in the sense that there will be some 50 to 70% reduction in long-term capital gains, which means that you will effectively end up paying some 15-16% tax, which is okay according to me. If that is passed, then I think it's quite reasonable. Well, I think as far as the long-term capital gains tax is concerned, under the current provisions also, if there is a provision of long-term capital gains tax. It's not that it is zero. It is zero only in the case of transactions on the stock market. That means if you buy and sell shares there, then it is zero. Otherwise, there is a tax provision here. What was wrong was the thought of taxing at the maximum rate, and that seems to have been corrected in the revised draft. You are right, we are in businesses, we are in many businesses where in SPVs, for example, in case of infrastructure sector, we keep churning the portfolio, and that's the way in this business is normally run. And therefore, if it is brought down to a reasonable level, I think if we are making some long-term capital gain, it is all right to pay some tax in the 10 to 15%. We believe that the provision which has been now brought about, or which is going to be tabled, will be in that range, around 15% or so, which in our view is okay.